Welcome to Clarity, a podcast powered by the Thomson Reuters Institute. I'm Zach Warren, the Institute's Technology and Innovation Insights Lead. In each episode, we dive deep into a single question from decision makers and thought leaders from legal, corporate, tax accounting and audit, and government communities. In today's episode, we discuss the big question: how has the economic volatility and uncertainty in recent months impacted law firm financial performance? For years, the law firm world has seen consistent rate hikes and generally positive performance. But according to the recently released Law Firm Financial Index for Q1 of 2025, we are entering potentially turbulent times. The report details a trade war whiplash in which rates continue to rise, but demand to start the year is sluggish. The past can be used to predict the future, but does that hold when the present is entering unprecedented territory? Today, TRI's Bill Josten speaks with Ballard Spahr Chief Financial Officer Belinda Jones and TRI Industry Analytics Manager Isaac Brooks about what a turbulent financial beginning to 2025 may mean for the rest of the year.
Hello, everyone, and welcome to the latest episode of Clarity from the Thomson Reuters Institute. Today, we're discussing the Q1 2025 financial performance of law firms based on the latest Law Firm Financial Index, commonly known as the LFFI, from the Thomson Reuters Institute. We have with us a couple of fantastic guests today. First is Isaac Brooks, who I have had the pleasure of working with for several years on an innumerable number of thought leadership reports. And he and his team of analysts take on the quarterly task of producing the LFFI and doing a lot of the financial analysis that comes to the market and ultimately goes into contributing to producing that LFFI report. So we're thrilled to have you with us today, Isaac. And we're also pleased to be joined by Belinda Jones, the Chief Financial Officer from Ballard Spahr. Belinda oversees the financial activities and management of Ballard Spahr, including financial planning and analysis, centralized billing, financial systems, firm accounting, and client account services. She brings nearly 2 decades of experience in managing financial objectives, strategic financial planning, and maximizing overall financial health for law firms to today's conversation. Those of you who participate in the Financial Insights program would have had the opportunity to hear Belinda a couple of weeks ago on our quarterly legal industry update. And we're thrilled to be able to bring in even just a little bit of the expertise you were able to share on that longer format webinar program, Belinda. But we're so thrilled to have you with us.
Thank you.
So let's give a framework for what we're going to be talking about on today's podcast, and that is the LFFI itself and what the LFFI told us about the quarter. The first quarter of 2025 presented really a complex picture for law firms. We had some good, we had some bad, we had some things where not as bad was kind of good, and some things where not as good was kind of bad. It was a very mixed quarter in terms of overall financial results. Despite starting the year with what we saw as really aggressive rate hikes, since really the most aggressive rate hikes we've seen in the legal industry since 2005, we saw initial forecasts of sort of sluggish demand. When we talk about those rate increases, rates increased by 7.3% for the average firm. And if we talk about that as the context of the average firm, that means some firms didn't grow by quite that much. Other firms grew by even more than that. So 7.3% average rate growth is really incredibly strong and aggressive, not in a bad way, but just as a statement of fact. But that did have an impact on where we thought demand was going to go. Then we hit really the latter part of March and saw what has been termed as the global trade war really kick off. And this dramatically shifted dynamics late in the quarter. It caused a surge in client demand, particularly as we saw litigation and tax practices. Now, this late spike in demand wasn't enough to lift overall quarterly demand above what we saw in Q4 of last year. As a result, we did see productivity dip, but we did notice that upward trend, and that's something that we are kind of watching as we move into Q2 and the rest of the year. But there's also some cautionary tales there about what that may mean beyond Q2 into Q3, Q4, and possibly even beyond. And we're going to talk a little bit about that. At the same time, talking about financial health, firms saw improved rate realization as clients seemingly prioritized their urgent needs to cover negotiations and those other things. But we also saw a sharp rise in direct expenses, those expenses associated with the attorneys at the firm, not the equity partners, but all the other attorneys. Those grew by 7.6% in the quarter, and that actually outpaced even that aggressive pace of rate growth. This presents a scenario where short-term prospects boosted by the trade war seem strong, but could potentially mask long-term risks reminiscent of sort of the immediate pre-GFC or Great Financial Crisis period. And this is leaving firms facing some difficult expense management decisions. As a result of all of this, when we look at the numbers, the performance of demand, rates, expenses, productivity, we saw that high degree of volatility, and the overall LFFI index figure dropped 13 points from a 64 to a 51. Not necessarily time to be, you know, sounding the klaxons and calling it an absolute emergency, but we definitely want to be looking at battening down the hatches a bit. So with that, it's quite a tee up for a conversation. But let's dive into some of these findings in a bit more depth. Now, Isaac, I'll start with you since your team did the lion's share of the work in doing the analysis and producing the report. The report describes what was termed a trade war whiplash. Can you elaborate on how the sudden surge of demand in March, specifically in some of the countercyclical practices like litigation, but also in transactional work like tax, contrasted with trends that we had seen early in the quarter and impacted that overall demand growth figure, which came in at 0.5%. It's growth on growth, which is good, but maybe not quite what we had anticipated in certain areas. Can you walk us through some of that?
Absolutely, Bill. And I think that as a preface, it always kind of depends on where your expectations are for a quarter. And then that kind of tells the story alongside of it. And I would say that, we look at reports across the industry, other benchmarking platforms, and we felt like we were somewhat alone on the fact that we didn't have a ton of high hopes for 2025. And not that it was going to be a bad year, but that the pace of where the law firm market has been growing at is just not typically sustained over multiple years. And that we saw that litigation was kind of probably trending towards maybe some worse performance in the year, and that was going to drag on performance. And through December of last year, through January of this year, we felt like we were pretty much right on track. We knew that there was going to be a working day down. And so overall, we were expecting maybe flat to slight contraction. And so for law firms to come in at 0.5%, and really that kind of surpassed our expectations. And what was really surprising as the trade war started to heat up, where we started to see more actions somewhat in February, starting to see greater actions in the lead up to April 2nd, that where we had a huge unleashing of a bunch of different tariffs. We just saw that legal work across all of the spectrum, whether it's countercyclical practices like litigation, like labor employment, that may have be more domestic trends kind of influence. But in addition, transactional deal work like tax work really accelerated from February to March, where in March, all working days adjusted, we'd almost see a 3% growth rate. So it was hard because the earlier of the quarter wasn't great, but by the end of it, it kind of bolstered with every segment seeing success, with those rate increases coming in, and with every practice area starting to accelerate, painted a much more promising picture than maybe us at the analyst team expected, which kind of changes, I think, is a change of pace from what other people in the industry have been reporting.
Yeah, it's always interesting. We've seen this consistent pattern almost of inconsistency, if you will, in the market, where we sort of get our thoughts collected on how things are trending, and then something changes, right? Something a bit unforeseen or maybe a bit more aggressive than we thought. And so some of those initial impressions are forced to sort of readapt to the market. And we'll talk a little bit more, particularly some of those demand things in just a second. But Belinda, I want to come to you because I think one of the big headlines really of Q1 has to be the rates picture. When we talk about an average rate increase of 7.3% in Q1, and I mentioned before, that means some firms were growing by probably quite a bit more than that. We saw that correlate with also an increase in realization, which it could maybe be a suggestion that at least in the first quarter of this year, clients weren't as concerned at pushing back because they had other things and other priorities on their mind that may shift later in the year. So I'm curious, Belinda, from your perspective, first, how was the rate setting process for the firm going in, or for firms in general? You don't have to necessarily speak specifically to Ballard Spahr's process, but just in general, how was the rate setting process and those discussions going into 2025? And as we look at moving through the rest of the year, what are you going to be watching to gauge the success of or stickiness of those rate increases for the rest of the year?
Well, I think for the rate setting process, as in every other year, it's a balancing act, right, between the increased costs that we have on our side and also, of course, the client's desire for smaller rate increases or none at all. So it's a balancing act there. We try to come to a number that we can all we think we can live with and the clients can live with, and then we take it from there. So I don't think there was anything really different in that rate setting process early, before the beginning of the year. And as far as, January rolls around and you have all the clients who have exception rates, which for everyone, that list gets bigger and bigger every year. There are a lot of rate arrangements that you come to with your clients. Then you begin that negotiation process. So in the first part of the year, you usually expect that your realization isn't going to go up because the standard rate is going to be higher, and the rates you're getting at that point have not necessarily moved up in all cases because you're still in negotiations. We did see that our rates went up, and we realized a pretty good percentage of our increased rates. But we always expect the first quarter to be a little bit lower than what we expect our average rate to be by the time we get to the end of the year, because you are still in that negotiation phase, right? So what we generally do is we do our average rate, we set what we think we're going to hit, and then we kind of look at history to say, what does that mean for the first part of the year? What is the average rate going to look like? And generally speaking, that number that we hit at the end of the first quarter is usually within 1 or 2% of what our ultimate average rate is for the year. And this year was no exception. We kind of fell right in. So really, I would say, as of now, April was the same. So that's a little bit beyond the first quarter. And it feels like our rates stuck pretty well. And I don't know if that's the case with all law firms, obviously, but I think for the most part, our rates stuck pretty well. We saw the same pattern that we've seen in other years. So, and that's really all we can base it on, right? As we go through the rest of the year, obviously we'll be watching it for realization to go down, but we always assume when the rates go up, realization is going to go down. Our realization has not yet, but if it happens, I think we have enough cushion there for that to happen. We would just wait and see what happens. But for now, I think our rates have stuck. I think we can say they've stuck.
Well, and Q1 is always an interesting time to be watching realization, right? Because you're looking at, in a large part, probably collections of work done in the prior year under the prior rate schedule, but those payments are being made with the new rate schedule at least lingering in the back of the mind, right? So it's hard to get a real solid indication of realization based off of Q1. But I think the stuff you're talking about in terms of watching going into particularly Q2, I think are definitely going to be the right notes to be watching if you start to see that divergence. One of the metrics that we've been watching, I know, is what we termed equal fee collection. And it's essentially how much rate increase you can, or how much realization you can give up before you start to cancel out your rate increases. Is that one of the numbers that you're kind of keeping an eye on too, Belinda, is where that balance comes in?
Well, I think we do that. Yes, I think when we're looking at that balance when we're doing our budget, what we actually anticipate doing, what number do we get to if how realization is going to impact that. So I think we already kind of planned that. So we have those goals, those targets in mind, and if we can stay close, we kind of do what we call a scorecard with all our metrics and say, if we can stay within that bell curve, then we're pretty good. And that leaves us with the opportunity to ultimately make our budget for the year. And hopefully, obviously, we always hope to exceed it, but to hit our financial goals for the year. So we kind of set all of those numbers up as we're doing it. And when you're talking about the first quarter, to go back to what you said about looking at, you're collecting stuff from the last year, that's the reason in the first quarter, I actually focus more on billing realization than collection realization. Because once we bill it, we tend to collect, 98, 99% of what we bill. We don't have very many write-offs. So I'm looking at billing realization. If our billing realization is high enough against our standard rates, then we know that we are, our rates are sticking. And so collection realization does kind of mix apples and oranges a little bit. So I kind of stay away from looking at that when I'm judging my rates. I look more at what we're billing out, what we're actually able to get into the client's hands. Because generally when we can get it into the client's hands, it's after the negotiation's been done, it's after the rates have been agreed to, and we tend to collect everything we bill. So what can we bill? That's really what I'm looking at.
I think that's such a great insight. And Isaac will back me up on this. Billing realization is one of my favorite, but perhaps more underappreciated metrics, because I think your insight on that, Belinda, is so spot on. That is really indicative of what you're actually capable, what you're able to bill as a function of your standard rate. And the collection tends to travel relatively closely in parallel with that. We've seen that for years in our data. So I think that's a tremendous insight. The other function of what we're talking about in terms of some of these financial projections through the rest of the year is not just the price at which you can sell a unit, but also the overall number of units that you can sell, right? When we talk about demand for firm services. And we mentioned in sort of the prologue here, and for those who have read the LFFI, which, by the way, linked in the show notes, go out, grab a copy of it, and read through the whole thing yourself. It's only about 3 pages long. But we did see this shift in demand toward the ends of the quarter with spikes in litigation and tax work. And I'm curious, Belinda, has Ballard Spahr experienced a change in the type or urgency of legal services that clients are seeking recently? And is that more aligned perhaps with some of those trends that we're seeing in the market writ large, driven kind of by the rise of that trade war?
Well, I think our litigation is doing well this year, but I think our litigation tends to do well every year. So I don't know how much of that is due to any kind of change. One of the challenges I have in answering that question this year is at the beginning of this year is we merged with a smaller firm, Lane Powell, out in the Pacific Northwest, and we added about 150 attorneys. So we integrated all of their practices in with ours. So right now, I don't know if I have enough history to say whether any of the changes are directly due to the change, cross-selling and things like that, or if it's just natural growth. But otherwise, everybody right now, the transactional practices, the litigation practices, they're all doing pretty well thus far, knock on wood, as they say. But it's, we didn't see the lag at the beginning of the year either. That you're talking about the second quarter, or the first quarter, the second part of that was where we saw the surge. We had growth from the beginning beyond what we expected. So obviously we adjusted for the hours we expected to get from the additional attorneys, but we did better right from day one than we expected to. So maybe for a lot of firms, it was just March more than any other time, but I would say our growth, our increase in hours per fee earner per day, the total billable hours per attorney, those kind of things started in January for us.
Well, that's fantastic. And yeah, definitely knock wood and hope that continues, because that's a good situation to be in, especially coming out of a merger where you can, you're seeing, when you're seeing growth across the board and you have to ask the question, gee, is this all organic? How much of this is just because of the tie-up? It's certainly better than an alternative, sort of a more dystopian reality, right?
Yes, and I think a lot of that, yeah, I agree 100%. And I think we expected the growth, obviously, just on body count alone, but I think it helped that a lot of our attorneys very actively, early on when we decided to do this combination, there was a lot of effort put in across both firms to cross-sell and to work together to start building up for when January hit. So I have to feel that had a lot of help. We weren't coming from a completely standing start to try to integrate the practices together and the clients and the firm. It was something that they put a concerted effort into, and I think that made a huge difference.
Well, that may be a topic to explore in greater depth on a future podcast episode. So I'll make myself a note to potentially revisit that with you and maybe some of the other leadership, Belinda. Isaac, pulling you back into the conversation, Belinda mentioned that at least for their firm, they've seen good demand performance across the board, even in those transactional practices. When we talk specifically about M&A as a transactional practice, the mergers and acquisitions work, that was expected to have a strong 2025, but grew by only 2.6% in the first quarter. And I say only 2.6 because 2.6 is not an insignificant amount of growth. But I think that's one of the situations where less good is bad. 2.6% is good growth, but we had anticipated a higher figure. The report mentions that even with this growth, and I think this gives the context for that less good is bad sort of scenario, that the Q1 figure is still 11.7% below the high point of 2021 when we had sort of a transactional boom, and attributes the lag to, the report calls it, conflicting forces and lingering uncertainty. So based on the findings that you and the team have looked at, can you expand on what these specific forces and uncertainties might be?
Absolutely. And like you said, 2.6%, it was leading all practice areas. So to say that it's below, it was leading, but at the same time, people had higher expectations. I just think that can't be undersold. But really what I would say is, M&A almost grew by double digits in 2021. And ever since then, it's been 3 years of contraction, a 10% contraction year, a 4% contraction year, another 1%. And so only to go up by 2.6%, we tried to do the math with the really cool chart that showcases how far is it below pre-pandemic levels, how is it compared to, 2021 highs. But with that context in mind, this was the most lucrative practice and what people were the most excited about coming to the new year with the new administration. There was, a really kind of harsh stance from the Biden administration when it came to antitrust, and everyone was scrutinizing every deal. And a lot of deals just kind of waited on the sidelines for a while there. And there was an expectation that through deregulation, with hopefully a lowering interest rate, so the cost of transactions goes down, and plus more administration in positions like with the antitrust or the SEC, that there was going to be less barriers for this deal work to kind of fly through. And that's where I just don't think all of those came quite to the same fruition. And then in addition, the market was pricing in a 10% chance of tariffs being implemented to really any degree at all by the end of the year. And as we've seen, that was definitely an underestimation. And that kind of problemates and makes any kind of prospective deal work that you're going to do. All of those factors need to be reconsidered, the reevaluation of the companies involved. All of those factors just lead to a lot of paralysis by analysis. And the fact that we don't know how next day is going to change those same figures you just ran the day before. And I think that, without getting into many specifics, those are kind of the broad conflicting forces that have kind of led to maybe a below expectation reading from the LFFI in the first quarter.
So, Belinda, coming back to you, you mentioned that you've had a really good start. You had a strong Q1 sort of across the board for the firm. But in light of some of those lingering uncertainties that Isaac was just talking about, and we also see things like, certain market prognosticators increasing their prediction odds for recessions and other various economic potential problems. Does that impact or perhaps shift your firm's strategic thinking or decision making as you look towards the remainder of this year and what you're going to start planning for in 2026?
Well, I think what's going on out in the world, without going into it too much and being political, is chaos, right? It feels very chaotic. And every day, as Isaac said, every day you wake up and there's something else. And sometimes it's flip-flopping back and forth. So although we are paying attention to what's going on, you're always going to pay attention to what's going on out in the world. We're looking at our internally to see, regardless of what the causes are, the odds are there will be some sort of slowdown, right? How long it's going to last, how deep it's going to be, we don't know, but we are looking ahead and planning for that. But we were planning for that when we made our budget for this year. So we already had anticipated that growth would not be extreme, that we would not see a vast increase. We did not budget assuming a 10% increase in M&A or anything like that. So we kind of already anticipated that on our side. So right now what we're doing is just holding our fire, right? We're not making any big changes right now, but all you can do in these situations, regardless of what's causing it, in my view, whatever is happening outside the firm, all you can do is plan the what ifs, right? You look for if these changes stick, if the tariffs stick, whatever's happening in the economy, then where are the opportunities on one side for the legal industry? Where is there going to be work where there's not a lot of work in the past year or so? And where can you take advantage of that, for lack of a better word? And then on the other side is planning for what you're going to do internally to manage the expenses if the revenue does slow down. Hopefully with a good running start for this year, depending on what happens. In my view, it's more likely to be towards the end of the year that we really start seeing any kind of downturn, maybe the fourth quarter, maybe a little sooner. But we've had that before. We've had that where you were doing great the whole year and then you get to the fourth quarter. So we're planning ahead for that. We're looking at our expenses, figuring out what discretionary spending can be delayed till we see how things are going to go, or deferred until next year or later if necessary, and how to manage, excess capacity, all the things that we all should be managing every year, even if it's a good year, but we sometimes forget to do that when things are great. You don't pay as much attention on what you're spending your money on. You don't worry too much about the excess capacity or things like that because you're still having a great year. But you just have to pay attention to that every year. And we have begun doing that pretty much on a regular basis. We're always examining what we're spending and what we're doing. And we're just going to continue to do that this year. But obviously, we do that kind of in the budget process anyway. But this year, we're kind of looking at it as we have before other downturns and saying, where are the least painful ways we can adjust so that we can weather whatever comes? And then, we move on from there, because that's really all you can do, because we have literally no control over the factors outside the firm. All we can do is try to, sail through them as best we can. And I think that's the same for everyone.
Yeah, I think you're spot on. I've spoken with a lot of folks in the legal industry, and that has been largely the consensus is Q2, or, Q1 wasn't bad. Q2 is probably going to be okay. It's going to be the latter part of Q3 and Q4 if we start to see problems in the legal industry. And that's just because the legal market tends to be more of a lagging indicator of the economy as a whole, right? We've seen that over and over and over again. But I think you're wise to say that, a lot of this is stuff that we've seen and had to weather before. So you sort of make the plans that you need to make to be able to accommodate things as they come. I think that's a really great approach. Belinda Jones, CFO of Ballard Spahr, thank you so much for the phenomenal insights. I do have several notes that I at the very least, I'm going to follow up with you personally on, because I thought that was some very interesting stuff there. And I look forward to talking a little bit more about it going forward. And Isaac Brooks, it's always a pleasure, my friend. All the work that you and your team do to get those reports ready. It's great because it gives us interesting things to talk about in the market and on podcasts like this. And it's always great to have your insights firsthand as well. So thank you for joining us as well.
Thank you, Belinda, Bill, and Isaac, for your insights. As today's podcast noted, the general economic world can seem chaotic, but that does not mean today's law firms can wait for calmer waters before beginning to plan. Belinda said her firm is planning for the what ifs, and that's great advice. You can't anticipate every scenario, but game planning for even potential outcomes provides more flexibility to adjust as the unanticipated occurs. Thank you as always for joining us for Clarity, powered by the Thomson Reuters Institute. You can follow or subscribe to this podcast on your favorite podcast platform, and don't forget to share with your colleagues and leave a 5-star review. For more data-driven analysis of today's professional services market and in-depth conversations with industry thought leaders, visit us online at thomsonreuters.com/institute or follow us on LinkedIn under the Thomson Reuters Institute. Clarity is a production of Thomson Reuters, copyright Thomson Reuters 2025.